Hey, what's up, everybody? It's Matthew Mickey, and now we're going to start moving into the macroeconomic leading indicators, right? And so far, we've learned the real interest rates, the yield curves, corporate credit spreads, the empty money supply, how money's made, how QE is, and how to find liquidity through the Fed Reserve, and like what they're doing. And that's going to tell us whether we have value or growth. Now, we realize that the professional market is the collection of individuals and institutions, so consumers and businesses, right? And so we use the Fed Reserves and the money markets as a leading indicator to how these businesses and consumers are going to respond, right? Like how they're going to make decisions and how they allot their capital across asset classes, right? The Fed Reserve has a mandate, has multiple mandates, and they monitor the economic indicators every day because they don't get to control these businesses and consumers. However, their piece of the pie really has a huge effect. It affects them. Remember the credit cycle video and the economy video that I introduced this with, right? And so they're going to make their decisions in what they do with the money market based off of how these consumers and companies are within the credit cycle. So with that being said, we always got to remember that business and consumers make the economy, and the decisions they are making are based off of the relative price of money and risk across those asset classes. So if they need to take a loan out, and there's a lot of, interest that they have to pay for that loan, they might not grow their business. And then we talked about the cost of money and corporate credit spreads and aggregating the corporate bond and the index spread. All right. If you don't remember, go back to those videos and watch them, right? Corporate bond indices are predictors of expansions and contractions in the economy, right? Because remember, corporate bonds is how much these companies are trying to lend, and through these corporate bonds, and they're going to lend based off of how much interest. They're going to borrow based off of how much interest they have to pay on that loan. So businesses themselves, they report quarterly earnings, right? And I would say those quarterly earnings are just coincidental indicators, so you're confirming what you should already know when they come out, right? And they deal with these businesses have prices every day in the markets that you can track how they're doing as a leading indicator. So in real time, you can measure the business performance on top of sales to earnings, based off of what they're doing. So surveys, right? I like surveys because unlike real interest rates, the yield curve, corporate credit spreads, money supply, these business surveys that we're about to talk about can't be manipulated by the Fed Reserve. Surveys are not tradable instruments, so they don't have that big of a influence on why people hardly even pay attention to them, and they tell us everything. There's such a great insight into the economy, and they are, without a shadow of a doubt, a leading indicator to make trading decisions. And you can literally predict the future of the stock market based off of these leading indicators. So surveys in conjunction with the money market, so the money markets being the public system, and consumers and businesses being the private sector, they're vital components of traders' overall systematic process in figuring out which way the macro wind is going to be blowing, and therefore which way money is flowing in the financial markets, and which way is likely to flow in the future. So don't blow this off. You need to be watching these surveys that we're about to talk about. So the first one we're going to talk about is the Institution of Supply Management Manufacturer Report on Business, right? So the ISM, right? It releases a manufacturer report on business, okay, and the PMI, which is the Purchasing Manager Index, on the first business day of each month. Here's the link where you can find it, and just remember the ISM is also released. The ISM non-manufacturer report is reported each month as well, right? So I'll cover that in the next video, right? But remember, there are two private sector entities that make up the economy: businesses and consumer, right? The government and the money market is a public sector, right? And within the manufacturer sector makes up 20% of the U.S. economy, and services make up the 80%. However, don't discredit the 20% of the manufacturer sector because they are the heartbeat of what the service sector does. So I think of it like this: manufacturers are my companies, services are my consumers. And I use both of these, the non-manufacturer surveys and the institutional survey of manufacturer reports, as a leading indicator. Okay, so the ISM is broken down into 5 categories that I really care about. And every month, the top 300 manufacturing companies fills out this survey. And so we can see it reflects the physical goods bought and sold in the U.S. economies. And all this data goes back to 1947, and those 5 categories that it's measuring is new orders, production, employment, deliveries, and inventories. That comes together and builds what is known as the PMI. And we're going to break each one of these down, but first we have to talk about this. So we know that new orders, productions, employment, deliveries, and inventories is what makes up the PMI, right? And the PMI is a composite index based on seasonal adjusted diffusion index for the 5 sectors, right? And all a diffusion index measures is the degree to which a change in something is dispersed, spread out, or diffused in a particular group. So basically it's taking those 300 members and it's indicating their activities, right? Has it increased, decreased, or remained unchanged from the previous month, right? And so the ISM indexes are calculated by taking the percentage of respondents that report the activity has increased, decreased, or stayed the same, right? And then they're using half of the same percentage, effectively measuring their bias towards a positive above 50% or a negative below 50%, right? So an example of this would be if the response was 20% that is better condition and 70% is the same and 10% is worse, the diffusion index would be 55%. A reading of 50% indicates no change. A reading above 55 is good. A reading below 50 is bad. Okay, so we got new orders, which reflect the level of new orders from customers of the manufacturing business, and basically that means has there been a change, no change, or a negative change this month from last month. And this gives us some insight in between quarterly earning reports on what's going on with these companies, right? And then you got production, which measures the rate and direction of change, if any, the level of production at the manufacturer business. Employment reports the increase, decrease in the level of employments. Are they hiring, are they not hiring? And then you got supply deliveries, which reveals if deliveries from supplies are faster or slower at the manufacturing business, which gives us clear insight of the supply chain. And you have inventories, which reflects the increase or decrease of inventory levels at the manufacturing business. Okay, so here's a chart of the ISM and a linear regression of the ISM. So it shows us the best fit. It tells you the health of the manufacturing sector. You literally are looking at the business cycle. So we need to figure out from all data to a short-term data frame mindset the current market conditions and where we are in the business cycle. Are we expanding or contracting? We can see that the most of the data points to us being above 50 and we're in an unhealthy market when the ISM is below 50. So now let's layer GDP quarter on quarter on top of it and see how it does. So now we can see that as growth was flat and just barely moving, when the ISM started decreasing and went below 50, then the GDP went below and just crashed, and that led to COVID-19. But it started in 2019. So now let's look at the S&P 500 and how it leads that, right? In every peak and trough that we see, we can literally see that the ISM expands or contracts about 1 to 2 to 3 months before the S&P gets hit, which is why ISM is a leading indicator to the S&P. S&P is a leading indicator to GDP. Now we know that the ISM and the PMI composite of 5 things, and the ISM alone is a powerful leading indicator to the business cycle. And following it on a monthly basis will put the odds in our favor into what sector we need to be at, right? So when we look at the ISM, what you're actually looking at is a business cycle. When the ISM is above 50, it's a strong indicator that the U.S. economy is expanding, and therefore S&P 500 returns will likely be positive. And we can potentially predict that a one-on-one situation in the S&P 500 will rise to the GDP to rise, right? And that's going to be in, measuring the S&P 3 to 6 month lagging data with the GDP. It will show that the S&P 500 leads the GDP by 3 to 6 months. All right, but when the ISM falls below 50, it's a strong indication that the economy is contracting, and therefore S&P 500 returns will likely start going negative. And if the Fed Reserve does not act, we can potentially see that there'll be the S&P 500 is down month over month, and then the GDP will fall as well month over month. And so when the ISM is in decline from a peak, it's a strong indication that the rate of the economy growth is slowing down. And when it's peaky, if it's near a historical peak level, we can potentially predict that we're going to be seeing where the S&P 500 will start falling 3 to 6 months before the GDP starts falling. So, for example, we just hit a historical, level of 60 with the ISM, right? And then we start seeing the S&P start drifting downwards. We already know that growth is going to be going down as well. So the GDP will fall 1 to 2 quarters afterwards, right? And so when the ISM is in a decline from a peak, it is a strong indicator that the rate of economy growth expansion is just slowing down, right? All right. So when ISM troughs, though, is a strong indicator that so now we know that the ISM PMI comes from new orders, production, employment, deliveries, and inventories. And we are going to break that down even more in detail, which one of those are leading and lagging indicators themselves in the next class. And then from there, we'll go through and I'll teach you guys how to format this data, blah, blah, blah. And then we're going to do the same thing with the service ISM NMI. All right, guys, later.